own the theme, Investment and Distribution Strategies, the Road Ahead in a Dynamic Market. And joining us on this very special session, allow us 1 minute of transition. Ladies and gentlemen, please put your hands together for our esteemed moderator, Mr. Sanjay Agarwal, Senior Director, BFSI CareEdge Ratings. Joining him on the dais, we have our eminent panelists, Mr. Manish Srivastava, Executive Director, AnandRathi Wealth Limited, Mr. Gaurav Kapoor, Senior Vice President, Business Development and Marketing, BSE Limited, Ms. Sheela Kulkarni, Head of Market Development and Institutional Investor Relationships, World Gold Council, India, Mr. Vikas Goyal, Senior VP and State Head, Delhi NCR, Kotak Mahindra Asset Management Company Limited, and Mr. Anuj Gupta, Capital Market Expert. Unfortunately, S.K. Jinder sir has a meeting, so he couldn't join us for this session. I now extend the mic to Mr. Sanjay Agarwal to take the proceeding forward. Thank you.
So after a very insightful session in the morning and then panel one discussion, I'm sure the audience would like to be informed on the various nuances of investment and distribution strategies. So I thank ASSOCHAM for inviting us and giving us this forum. Now, taking to the figure that the panel, that the various speakers and the panel had discussed, that today the mutual fund AUM is about 19% of the GDP of the country, right? Globally, in US this figure is much higher, and globally also it's something about 66 to 70%. So the industry needs to probably triple at the current scale, and then also keep pace with the GDP growth, the nominal GDP growth, which the audience, with the earlier panelists had said would be about 12 to 13% per annum. So are we looking at an industry which will grow at 25 to 30% for the next 20 years? Do we have the strategies to deal with that situation? Can we produce enough products for the investing public to take it, for the mutual fund industry to take advantage of the requirements out there? So these would be the principal questions we would have on this panel. And I would start with each one of you, Mr. Gaurav Kapoor. Like, the industry right now is at something around 81 lakh crores, which is about 20% of the GDP of the country. Now, if we want to go to a figure of, say, 60 to 70% of the GDP, what should be done, and how can we, what would be the single biggest lever that can take the industry to that level?
Thank you, ASSOCHAM, for inviting BSE. And see, typically many things needs to be done, but if you're asking me, one is definitely financialization of, household savings from, physical assets to financial asset is something which needs to be done. But we also need to understand, are we targeting AUM, or are we targeting a number of investors getting onboarded to, to the mutual fund industry per se, right? If we are targeting, we also know that B30 cities, the participation is very, very low. It is hardly 20-25%, right? The major, participation is coming from the metros. So beyond B30 cities is where the population is. So product needs to be designed, distribution needs to be covered, right? Then only you will be able to reach out to them. So the WTM also mentioned, can there be a life cycle fund? So we only have one life cycle fund presently, which people understand is NPS, right? So how do we not only per se, because we are from the mutual fund industry, AMCs will be there, but NPS is one of the very good instrument, if I have to say, which people understand trust is being built, and the product is very simplified, right? Someone mentioned there are 5,000 AMs, 5,000 schemes which are already available. Even if you have a life cycle fund, then all those 50 AMCs are going to launch their life cycle fund. The customer would get confused, beyond B30 cities. So we need to identify which is the product which is relevant beyond B30 cities if we want to increase our investor base from 5.5 crores to a larger group. And for increasing the AUM, the strategy could be very different, because that could be a pool fund, that could be institutional fund, it could run through EPFO, NPS, SIF can be on the other side, and life cycle fund can be on the other side, and mutual fund, PEs, equity, debt can be on the other side.
Okay, so you say we need to break down the problem into two parts. One is the number of investors and then the overall AUM. And for number of investors, you are saying that we need to design products for B30 and beyond. And for the size, obviously, the institutional play would become more important. Right. And now I would take on Mr. Manish Srivastava that SRPs have contributed more than 25,000-30,000 per month in the last calendar year. And the accounts have crossed more than 8.5 crores. And as our WTM said, that for last 50-60 months, the equity inflows have been positive. And even in the earlier panel, we said that the SIP continues to be there at a record level despite the market volatility. So is this correct? Kya ye sahi hai? Has the Indian investor genuinely matured, or could we see a change in behavior during a prolonged bear market?
I think a very important question there. Thank you, first of all, Afsachand, for getting me here. And I think, it's very important for us to understand kya ye sahi hai. Well, if you see the SIP numbers, the SIP numbers have been upwards of 30,000, from March onwards. Yeah. And does it show maturity in the Indian investors? Yes. During very difficult times that we've seen the last 2 years, our SIP numbers have been consistently at an average of about 30,000. Now, what needs to be seen here is that not the number going up. I have a data which I wanted to, I have got it and I wanted to share that data with you guys, that in about 2021, the SIP, total SIP in India was about 96,000 crores. And by the end of financial year 2026, the SIP number grew from 96,000 crores to about 3.5 lakh crore, which is a phenomenal number to be in. If you see bear thread, from a 96,000 crores to about 3.5 lakh crore, which is a great number to be in. But what, has the investor matured? The answer is yes. Have we been investing monies into SIP in a volatile market? The answer is yes. But if you see from the past 2 months, if I see a very short data though, it is from April, our number in April actually degrew by about 3.5%, which means, our number on SIP was about 31,115 odd crores. And then in May, the number degrew by about 0.5%. So while, on the top, we are seeing that we are above 30,000 crores, that's a good point. But for the last 2 months, the numbers have gone a little down, and we have to see what number comes for June as well. So the point I'm trying to make here is that while it is a great number to be seen, SIPs have been consistent. They have been investing money into SIPs. Average has been 30,000 crores. But the actual number to be seen now, how the investor behaves when there are prolonged bear markets, that number has to be seen. The number that I would want to see now going forward would be that how have the investors behaved during the time that the markets are not good. At a good time, everybody will be investing monies in. But we've seen, it's a too short data for me to see April and May. But we need to see how investors behave during when the bear markets are. We haven't seen, people say, there has been a bear market for almost 2 years now. People have not seen a bear market as yet. I feel in these 2 years, we had enough and more hikes which were there. People have made money, but we have not seen actual bear markets. So there has been a great influx of SIPs coming into picture. But what we need to see is that in a bear market, the numbers that we need to see in is how investor behave during a bear market. Does he withdraws money from SIPs? Are the SIP numbers continues to go decline? I just wanted to also share one data. I'm carrying the data with me is, in the year 2024, our SIP numbers were 2 lakh crore. There was a growth of about 45% in SIP numbers from 2024 to 2025. Cut that, 25 to 26, the SIP number, grew only by about 21%. So that clearly talks about, well, maturity is there, but will it sustain needs to be seen. I always say, one thing that while bull market make investors, but bear market make decisive investors on. That's well said. So you're saying what would happen now is a multi-billion question, because SIPs per month is about 3.5 billion. So whether that will sustain or not. Yes. And that becomes an important thing. Yeah, that's the point to be seen, sir. Okay. Thank you. Yeah, Mr. Gaurav Kapoor, we've seen that passive investing has grown rapidly from 7% to 17%. And the speaker in the morning also alluded to the cost of passive investing, etc. So do you see ETF actually complementing active trades, or eventually it will disrupt the traditional AMC economics?
See, ETF, it's a very simple product for anyone to understand. But the major challenge in India for any financial product is the cost of distribution. So the people who are distributing this product, if they don't have the incentive, they are not going to pass the information, and they may not be able to distribute. And so that is the largest. So this product has been there for a very long period. It's a very simple product. The cost is low. But are the people who are distributing, because presently ETF is largely being distributed either through the AMC channel or it is through the broking channel. And broking channel, the revenue would largely be on a churning basis. And ETF, when we say it is a passive kind of investment, even though it is traded on the stock exchange, right? But the broker psyche, or the person who's advising, would always be wanting that ETF to get churned, and he may not be incentivized. Globally, we all know that ETF, active fund managers are not able to beat, as compared to the index funding. And this is also going to happen in India. We are in a growth phase at this point of time. That is why all asset classes are giving different returns in a different cycle, economic cycle. So gold is also giving because of some reason. Real estate is also giving because we have a higher population per se. So there is a demand there, and equity also is going to increase. But finally, end of the day, my sense is the large funds, the large fund, index funds, there everything will start moving towards, passive investing. Mid caps, small caps, where, the active fund manager, you require someone to actually pick up those stocks, right? Though whatever you call gems out of those, larger space, their active fund management will still be there. So passive fund management and ETF will pick up. Gold ETF picked up because the prices started moving, people started realizing. So these are some of the incidents where it picked up. ETF actually picked up because EPFO started investing into ETFs. Out of 1 lakh crore, which used to come every year, 15% they are supposed to invest. That is how they started investing in Nifty ETF and Sensex ETF. And most of the ETF passive AUM, which you see around 30.5 lakh crores, maximum 70 to 80% is institutional. And globally also it is either institutional or it is, endowment funds and all insurance companies putting those monies into pension funds. So larger focus will always be that, passive funds and ETF will have a flow from institutional. Retail will all depend upon, their own understanding of that product, how much that information reaches out to them. Because the distributor of that product may not be incentivized to promote that product.
So you're saying incentive becomes a very key product for ETF, but I think for this audience, the good news is in India, the active fund managers are beating the indices. So to that extent, the active funds would remain more widely distributed and received in the market compared to ETFs. The other news you are saying is that ETFs is largely institutional, so the active fund, the retail actually goes for the active fund, always subject to the fund managers being able to beat the indices and take it from there. Right. Okay. We move to Sheela, ma'am. So, given the so you are from the World Gold Council. Given the volatility in the gold prices over the last 5 to 6 months, if an investor has to invest 100 rupees, he has to allocate 100 rupees, how should the allocation be in terms of debt, equities and gold for next 10 years? So we're looking at a long period out here.
Firstly, thank you, ASSOCHAM, for having me. For those of you all who don't know, who the World Gold Council is and what we do, we are a not-for-profit organization, and we produce a lot of research, insights, and data on gold. I think we are the only body in the world that has so much of insights that is published on our website called gold.org. We don't sell anything. All you need is your email address to log in and download all the information that you want on gold. To answer your question, I think the previous panel also discussed a lot about gold, silver, and commodities in general. Before I share some light on what should be the allocation for the next 10 years, let's take a step back. Gold has been one of the best performing asset classes over the past few years. Even on a year-to-year basis, if you look at gold, it has given returns in excess of 40%. Obviously, the war created a shock, and if you compare, all other investable assets versus gold, apart from emerging market, stocks, gold is still the number one performing asset class. Now, the war came as a shock, and gold had spiked before that. Typically, what happens is when an asset class starts doing well, a lot of speculators also come in. And what happened after the war, or just before the war as well, was the uncertainty around the announcement of the Fed chair, and therefore what would be their stand. The second was, of course, the war, which created a shock, and therefore also the need for liquidity. So a lot of speculators actually stepped away from gold. People, when they need liquidity, they need to sell some assets, right? And this is where gold did what it was expected to do, which is provide liquidity. So, whether it was for margin calls, whether it was, to meet requirements of various nature, or just for portfolio rebalancing, we saw a lot of investors exit gold. Having said this, in terms of the past few years, we've seen, and especially so after COVID, gold has become one of the most popular asset classes, and also, like I said earlier, one of the best performing asset classes. Let's think about what actually drives gold demand. From a strategic basis, there are two major components that drive gold demand. One is risk and uncertainty, and the other is economic expansion. Periods of economic expansion are actually very conducive to investment in gold from a long-term perspective, as well as conducive to jewelry purchases. Yeah. So if you look at what is happening now is that we have seen gold come off its highs, but gold is a strategic asset. And what typically happens is, when you have inflationary shocks, gold doesn't do well, but in periods of persistent inflation, gold does perform well. So whilst we are not, I'm not a financial advisor and I'm not qualified to give this advice, we think that anywhere between 10 to 15% would be good for gold. Look at gold as a diversifier and as a portfolio insurance. Think about what you need from a portfolio when every other asset class is actually not doing too well, which is, an insurance for your portfolio, and that is given by gold. So a range of 10 to 15% we think is a good number.
Okay, now we are actually in Delhi, which is capital of North India. And you said you know everything about gold, and everything about gold is there on your website. So the audience would like to know what will be the gold prices in next 6 months, 12 months and 24 months.
I'm afraid we are not allowed to give a price outlook, but we've just published 2 days ago a mid-year outlook where we've given a range, I would urge all of you to actually look at our mid-year outlook. We are also the founders of the world's largest gold-backed ETF, which is run by State Street for us, and it's listed on the NYC. So we are not allowed to give a price outlook, I'm afraid. Thanks.
So that is the benefit of being a regulated player, that you do sell dreams, but you don't tell people what the dreams are made of. So that's a nice way of putting things. Now coming to Anuj, has the growth of direct plans improved investor outcomes, or has it widened the advice gaps in the selling fees, etc.? They're not very low.
Thank you, SHM, to having me. See, right now the time is the expertise. Everybody is like to invest with the research and with expertise, with the experts. Earlier, 10 years before, people are just investing in the mutual funds by just investing, right? So in direct in the plans, people are not, investors are not able to take advice from the expert, right? As there is lots of SEBI registered research analysts, SEBI registered market advisors. So direct investors are not able to take advice because they are investing directly. But if you are investing in the regular plan, you can take advice from the advisor. Even they can charge some fees. But in regular plan, they cannot, they are not charging any fee, or they cannot have to pay to the advisor. So there is some, the save of the amount. So that will help to increase the AUM. That will increase to the returns, or you can say that will help to increase the overall ROI. So direct plan always be a good for the investor who are the tech savvy, who are doing research by their own, and who are very actively in the market, because right now market is very volatile. So every time we have to keep in mind that market may go anywhere. So for the perspective, direct plan are good for those investors, but regular plan are good for those investors who are not actively look to the market. And obviously it will give some charges. It will there is some charges which will be the data from the investment amount. So direct plans always are good for the investor who are tech savvy, or who are very informative, or who are very the good for the markets.
So you're saying the investors in direct plan is a very small set compared to the overall set of investors.
Yes, because right now everybody is want to invest with expertise, and they want to give their amount also. I mean, they want to give their fees also. So right now in India, everybody is looking towards the experts. As I am also a SEBI registered, so everybody is looking कि कहाँ investment करना है, क्या आपको investment करना है. They are not investing blindly. So at the mutual fund, in the stock market, in the commodity market, everybody is want the expert. So regular plan, they can have the expert, and even direct plan owners also hire some experts and pay their fees.
So you can say, what you're saying is, for advice, probably the direct plans can be, direct plan users may be paying something extra to somebody.
Yes, they can hire SEBI registered advisors, and they can pay the fees.
Right. Yeah. Investment advisors. So, but on a broad level, you are saying the base approach should be to go for regular plans. If you are very confident and you are very strong in your research and understanding, then probably you can go for direct plans.
Yes, if you are able to manage your fund by their own, then you can go for the direct. But if you don't have a time, if you don't have the market knowledge, then you have to go for the regular plan.
Okay, we'll come back to Manish before we go to Vikas. So, are shrinking commissions, rising compliance cost, and fintech competition like direct plans, etc., making mutual fund distribution business economically unsustainable?
I think very valid question at this point in time. And I myself, we're working with AnandRathi Wealth for the past 18 years. Shrinking commissions, I don't think so. This is a very relevant, question for us. Why? Because AnandRathi Wealth manages close to about 1 lakh crore of AUM. And today, my 65% business is mutual fund distribution. And yes, there was a time when I used to work with banks. Our commissions used to be about 2.5%. That has come down from 2.5% to about a percentage now. But even at 90 bips to about percentage coming in, and compliance is coming strong, I think what people, the testimony of the fact that we are managing about 1 lakh crore of AUM, which about 65% is on regular business, not on a direct basis. The testament to the fact saying that people value the kind of research that you have. People value the kind of thought process that we have on a mutual fund distribution basis. And even the fintech company which are coming in, all said and done in India, as we grow up, what I feel is that connection between a human is very, very important. And today also we feel, the younger generation may be getting into a fintech, getting into an app and buying it. Mutual funds are available over the counter, as I say, but there's so much research which is important to be done in a mutual fund business itself. And I feel very happy, about saying that, the kind of work most of the distributors which have been doing now, if they can create an alpha about 3 to 4% on the mutual fund portfolio that they manage for their clients, I think this commission business absolutely will not have any impact on. And we are very proudly managing, about 65% of our money is into mutual funds, and we are very happy about it. And the commissions may shrink, but people will value the kind of research and returns that you generate for them.
So of this 65, is it all regular plans or you do?
We are 100% regular plan, sir.
Okay.
We are 100% regular plan. We do not do anything in advisory mode.
So you are saying that if you have a good research abilities and a good thought process which can give alpha of 3 to 4%, then
yes,
competition is not an issue, right?
Absolutely not.
So the distributors have to be far more better planned and organized to do this business.
Absolutely.
Very good. Thanks.
Thank you.
So Vikas, in the earlier panel also we had seen some discussion on debt funds. So with the removal of taxation benefits, many believe that debt funds would be irrelevant, right? Can the debt fund reinvent themselves to grow meaningfully from the current level of something around $200 billion?
Yeah. So thanks, Sanjay. Thanks, SHM, for having me here. Thanks to the fellow panelists and the esteemed audience. So good and very relevant topic and the question. This removal of the indexation benefit undoubtedly, has weakened the compelling, reason for the affluent investor to use debt funds versus the direct bonds or maybe the, deposits. But then, however, it does not mean that it has lost its relevance, all right? And, from the current level of $200 billion of AUM, I believe it can grow multiple to its size, provided, to that, industry will have to shift its value proposition, from the risk, from the, tax arbitrage to the portfolio solution, liquidity and the risk management. But the issue is, today the risk management is a very underrated term, right? And, the trend in last 5 years has been more of a momentum chasing, okay? And this has been, it is more of a tax arbitrage for the ultra HNIs and maybe the corporates, but then it gives you a lot of benefits like daily liquidity, all right, similar to the equity portfolio, investing only the multiple debt bonds, okay, reducing the risk of the default, maybe, when the individual investor is investing into the individual bond, and multiple other things, it helps you managing your portfolio well. So I'll just share one data point. Last 2 years, returns of the corporate bond category is around 7.5 to 7.8% CAGR, all right? Which means it has added more than 15% to the portfolio return. And where is the Nifty? Nifty is around flat or maybe 0.5% here and there. I'm not trying to say that debt is better than equity or equity is better than that. But then every asset class has its relevance to the portfolio, and it's the advisor who can, take the best decision in the interest of the investor and accordingly place the product.
So you're saying now risk management has to become far more important in the whole scheme of things than what it was being till now, because you're saying in past 2 years, debt funds probably, corporate debt funds have given 15% type of return, whereas Nifty at a ETF level would practically be flat.
Absolutely. So we have seen the momentum chasing in equity. We have seen the momentum chasing in debt, gold and silver. All right. So that has to go. We have to move beyond the returns And definitely the risk management has to be the part, as Anuj said, as Mr. Manish mentioned, the expertise of portfolio management is more important, and the advisor needs to take the decision in the interest of the investor. I think that.
Okay, so I think we are coming to almost the close of the session. I have one question I'd like to repeat to the panelists, that which I had already discussed with Gaurav, that mutual fund industry is right now 19 to 20% of the GDP, whereas the Asian average is something around 70%. So what is that one thing that this question is to Vikas, that what is that one thing that the mutual fund industry needs to do to reach to that level?
So more and more awareness, definitely. As you know, we are doing this session in the heart of the nation, Delhi, and I'm sure Mumbai keep on doing more and more sessions. We need to go beyond these boundaries. We need to travel to the tier 2, tier 3 cities, and we need to make an environment where all sort of structure can coexist, like distribution, or maybe the RIA, okay, or maybe the fintech and all. So I think we have done so with the help of regulators. They've been, very effective in the last 15, 20 years. I think we need to make it more robust to take this industry, AUM in percentage to GDP to around 50-60%. And I'm sure next 4-5 years we'll see that number.
So you're saying basically awareness and logistics are the two key drivers out here?
Absolutely. For any industry, awareness and logistics, is the most important thing.
Okay. Anuj, other than this, any suggestion you have, other than what the two panelists have already said?
I think industry should launch some more commodity-driven ETFs, because currently we have gold and silver, but internationally we have copper ETF also. So if we want to get more customer for investment side, for trading-centric customers, so we have to that kind of ETF, because in last 5-10 years we saw a very good appreciation in AUM of the gold and silver ETF. So ETF, I think, commodity ETF, I think that should be in the more portfolio.
Okay, Sheela, Kulkarni, what do you would suggest?
I think I agree with what both Vikas and Anuj have said. One is, having more products, creating more awareness. From a gold perspective, Indians love gold. But having said this, gold ETFs have only started growing recently in the past few years, especially since COVID. And gold is quasi-currency. Apart from, the dollar, there is no other reserve asset currency that we have. So we've seen central banks also increase their purchases because there's no substitute, that we can say we have to the dollar. So allocations are increasing, but awareness levels also need to increase from an investment perspective, because jewelry is not investment. Thanks.
Okay. We can have one question from the audience. If anybody
Can I add to her here, please?
Yeah.
One very important thing that I wanted to say on that. If you want to increase from 20% to about 50%, that means about 1.7 lakh crore of AUM should be there by about 2030. One very important part, what needs to be seen is, in the US in 1978, they started something called 401k investments, which meant that from your salary itself, the money would move into equities. If something of that, if India really wants to move up into, getting mutual funds to a different level, something of this sort also can be done here in India. While monies are getting invested in EPFO, PPF, NPS, I think that alone will not do, if we really want. And our distribution is phenomenal. If you see Jan Dhan account we opened, right? We have post office. Post offices are also mandated to sell mutual funds, but they aren't selling it. But look at the reach of the post office that has gone on to. So if we start, if we have that, rather than doing SIP on my own, if my salary automatically comes and 10% gets deducted and gets into an SIP, look at the working class that we have. So if you really want to, get into a level in the next 4-5 years, there's certain things one needs to be done. And India specifically saves close to about 45 lakh to about 50 lakh crore every year. 1% shift from physical asset, which is mostly we are 70% into physical assets today. If it shifts from physical assets to financial assets, that will add about 14 to 15 lakh crore every year.
I think SEBI has recently floated a consultation paper to this effect, where from your salaries, if money could actually move out.
Absolutely. That will be a game changer there. Sorry.
Just from this gentleman. Please keep your whole discussion short, please.
One is the dividend even of 12 rupees is considered as income from other sources. Even 12 rupees, 15 rupees, 100 rupees, 1,100 rupees, 50 rupees is considered as other income from other sources. Some limit should be there. Okay, below 1,000 rupees or below 1,200 rupees, that should not be considered as a income from other sources. Point number 2 is the TDS. Small investors, they are investing in single asset management, 10,000 rupees.
I think there is some confusion because in mutual fund, I don't think there is any TDS. So
No. The TDS on the income. If the income
mutual
is,
fund, there is no TDS, right?
yeah, dividend. From the dividend, if it is from the dividend, if it is more than 10,000
Hello.
rupees, it is taxable, 10%.
Thank you, sir. Thank you,
And
sir.
and the last is the, if I take a loan from the, to invest in the mutual fund, now it is again, the benefit is not there. Earlier it was there, from the April 26th.
Yeah, we
it was-
covered that in our discussion, right?
We have
Thank you.
already covered, so thank you, sir.
Sanjay,
Sir, my question is to Mr. Manish Srivastav. I am not going in detail because you have already explained everything. The question which is I just will ask, I think 90% of the audience, they might be having this question in their mind. So far as this mutual fund is concerned, I can say that the most of the times, the fund managers, sometimes they take wrong decisions on the later stage. And my question is, what additional safeguards or transparency measures are needed in the mutual fund industry to ensure that investors are protected? Thank you.
Thank you, sir.
My question is to Mr. Manish Srivastav.
Well, so SEBI has, has been, I think, the first and the foremost. They've regulated mutual fund very tightly. It is very difficult for any fund managers to go ahead and do something which is not beyond our control. The only thing is that, yes, mutual funds are also human beings, right? There are about 456 active mutual funds which are there, equity mutual funds. There can be a possibility, if you see in a year's time frame, a difference between a good performing fund to a bad performing fund in the same year is vast. There's a lot of dispersion which is there. It is extremely important, SEBI will do what they want to do, and they have been doing it, on the disclosures and everything. From a common man's perspective, I think it's extremely important for us to be abreast with what is happening in the market at this point in time. And your advisors, advisors are also human. Like in AnandRathi, we have a model portfolio. I do not have, a kind of, I will say, a plan with a client saying that all my mutual fund portfolios, funds will do well. But my objective with my client is that on an overall basis, if I can maintain a 3 to 4% kind of an alpha on your portfolio from the markets, I have done my job. Yeah, so that's what it is.
So I think what you're saying is that it is not just the responsibility of SEBI, it's also the responsibility of advisors to make sure that you choose the right funds and fund managers. And that is where you said about the research, that is where it comes in. Right, so that's all from my side.
Mr. Kapoor, you want to add something, so please go ahead.
I was just mentioning BAC per se. What we have done is we've tied up with post office, right? Because post office has 1.5 lakh, distribution. So we have tied up BAC processes, BAC star MF processes almost 85% of the transaction, and almost 8 crore transactions every month, right? So we've tied up with post office so that the distribution is reached at the last mile. Definitely education and all those things needs to be done. And also we have extended our MF platform to the NPS trust, so that it is agnostic to one product per se, because already the technology backbone is being created. And if you have to reach to the far rung places, you can't go with one product. It has to be a distributed simple product. So we've also are working with NPS trust so that the same network can be used and the same technology can be passed on.
Anuj.
So on a lighter note, I think we should focus on Gen Z, because there's a lots of Gen Z who are still trading, but they are not investing. And they are, looking towards those products which are very high volatile. So I think before 10 years before, we talked about the gold ETF, but that was not there. But right now, today, we have cryptocurrency. I think we should look towards cryptocurrency ETF. That will be, I think, after 10 years, we will think, yes, we should have. I think government is also working on that. So cryptocurrency is a new product. I think we should look towards that also.
Thank you,
I
sir.
think, there would be a lot of points to be discussed, but we would formally close the session here.
We have short time. But nevertheless, thank you to our session moderator and all our esteemed panelists for this insightful panel discussion. I would request you all to kindly take your seat for a group photograph, right? Yeah. Ladies and gentlemen, please put your hands together for all our esteemed panelists and our session moderator for creating such an insightful panel discussion. Thank you, sir. Thank you, ma'am. We now move to our final panel discussion.